A very good morning to everyone. Today I would like to explain subtopic 2.7, which is about accounting standards and practices. Learning outcome. At the end of the course, students able to explain the context related to an actuarial environment. Describe the areas involving actuarial knowledge. Know how to apply basic actuarial knowledge. Definition of accounting standards. An accounting standards is a principles that guide and standardize financial accounting practices, such as how a firm prepares and presents its business income, expenses, assets and liabilities. Example of accounting standards are statutory accounting practices, STAT. Generally accepted accounting principles for financial reporting, GAAP. International Financial Reporting Standards, IFRS. The example of accounting standards. Generally accepted accounting principles, GAAP, refer to a common set of accounting principles, standards and procedures issued by the Financial Accounting Standards Board, FASB. Furthermore, GAAP is a combination of authoritative standards set by policy boards and the commonly accepted methods for documenting and reporting accounting data. The example of accounting standards. Next, International Financial Reporting Standards, IFRS, lay down common rules so that financial statements around the world can be consistent, transparent and comparable. IFRS are issued by the International Accounting Standards Board, IASB. IFRS define how businesses will manage and disclose their accounts, identifying transaction forms and other financially impact events. IFRS have been established to create a common accounting language so that companies and their accounts can be consistent and accurate from company to company and from country to country. Accounting standards and practices. Company accounts have to be prepared in accordance with accounting standards such as GAAP and FAS. Accounting standards affect virtually all type of actuarial work. Moreover, they may set out general nature, to a greater or lesser degree, of the assumption to be made when performing evaluation of almost anything whose value is included in financial statements. For example, the liabilities of a retirement benefit plan and the outstanding claims of General Insurance Company. Accounting standards and practices. For example, in Australia the Accounting Standards AS 25 specifies the type of assumptions that must be in liability and asset valuations shows in retirement benefit fund accounts. Furthermore, an actuary may choose to use different assumptions in performing an actuarial review for funding purpose. The actuary need to explain to the trustees and sponsoring employer why the accounts show different values to those in the actuary's report. Actuarial assumption are an estimate of an uncertain variable input into a financial model, normally for the purposes of calculating premiums or benefits. Accounting standards and practices. Moreover, accounting standards may address the way in which insurance companies report their activities. For example, in general insurance, aspects affected are likely to include the definition of premiums, accounting for deferred acquisition costs, accounting for reinsurance payments, apportioning management expenses and determining outstanding claim liabilities. If prudential regulations for general insurers call for a different approach to estimating outstanding claim liabilities, then a different value will be determined from that appearing in the published account.